Legends, welcome to episode 2 of How to Make Money with Futures in 2025. Today's lecture is going to be about why does price move, and this is going to be the chronology. Price seeks liquidity to fill orders. Market is engineered for optimal delivery, not randomness. Because some people say you buy and sell with your eyes closed, you make money half the time. You don't make money half the time. You lose actually 80% of the time. Imbalance and inefficiency drive movement. Fair value gaps, example of price and two imbalances. Motive of price is pre-decided. High time frame movement, right? So I'm just going to put this in some random corner and then go one by one because I do have my notes with me. So price seeks liquidity to fill orders. What does that mean? So let me go on the 4-hour chart. Let me first explain what liquidity is, right? So this is the video of someone who posted the bookmap to ES and NQ. ES is S&P 500 futures and Nasdaq is Nasdaq 100 futures. So you can see, if you look closely, you can see here the orders in green and the orders in red. You see these lines on the chart? These are orders that were placed and deleted. You see the fucked up lines here? This is a place where orders was placed, but they were deleted. If you look even more carefully, I'm going to try to zoom in here. Yeah. So you're going to see some lines pop up and disappear within a few seconds, right? So I'm just going to wait a few seconds till we see that. Yeah, you saw that right here. You saw this right here. Yeah, all that, right? So what is that? That's people placing orders and moving those orders. For example, you would put a limit order, you would delete a limit order. You would put a buy stop, you remove a buy stop, right? So you place an order and you remove an order. So this is a book map, exactly what it means, a map to the book. Where are the orders lying, right? So for example, if you see here, price went down. This is the ES book map, as you can see here. So price kept going down to this level. Red means the highest intensity, right? So red means high intensity, blue means no intensity, right? So you can think of it as a spectrum. So there were a lot of orders here. Price came really close to this but did not fill it, but went the other way, right? Today is a bank holiday. Market closes early, so there's not much volume for us to observe. So this is also a footprint chart, by the way. But anyway, right? So liquidity is orders that are everywhere, right? And logically, or there will be more orders underneath the highs and lows rather than this random space in between, right? For example, 21,725. 21,724 to 4.5, right? So there's a lot of orders here compared to basically everything else. There's some orders at 21,760, 21,760. Yeah, so right about here, right? So there's orders here, right? Ideally there should be orders near 740 as well. 740, no, not really, right? So like I said, today is not a really good example because there's not enough volume. Look at this, right? So there's, on the top you can see there's only about 60 contracts traded, 60 contracts, 59, 87. At any point there's not more than 200 contracts traded, right? And 200 contracts is very little because at any point, for example, let's check ES. Even on a low day like this, low volume day like this, on the top you can see there's 200 contracts, and around market open they're probably like, yeah, 2,000 contracts, right? So that's more of a representation of what the market is actually like and not what it always is, right? So close this, go back to Nasdaq chart, right? So price is only moving to fill orders, right? Forget about a lot of people buying, so it goes up, a lot of people selling, so it goes down. That's not how it works, right? So I'll show you why and how it works, right? So this move, it looks like a really strong move. Sellers were strong, whatever the fuck, right? There's a reason why they made the move. I've been trading today, so I know exactly what happened. I'll show you why. So this is the daily chart. One candle is 1 day. This was the PDH, previous day low. Sorry. And oh, sorry. This is the NQ1 Nasdaq continuous contract. We gotta use the Nasdaq NQU contract. So this was, what is this? 16th June low, right? And this was 13th June low. Now look, you see how price was moving with a motive till it got to this point, and then it's just fucking around. It's just doing nothing at all. You see these, it goes down, back to fair value gap, back to fair value gap, back to fair value gap, and then this is the motive for today. Once this is reached, essentially this candle, after this candle, not much is gonna happen, right? Sometimes this is how I see it, right? So for example, if I'm wrong, there could be another move up here to take out these highs, equal highs, but we have no idea, right? But for now, this is what the narrative is, and this is what the motive was for today. Once this is done, price is doing nothing at all. Look at the 5-minute chart, nothing's happening. Look at the 1-minute chart, nothing's happening. Yeah, sure, it goes up and down, but a range of about 80 points, right? So 80 points is absolutely nothing, because take a look at this. This is 9:30 and this is 9:48. So 18 minutes, it moved 135 points. So when price is moving with the motive, it's going to move fast. And if there is no motive, or if the motive is completed, this is what happens, right? So now that it is clear that price is moving to fill orders, and how is it going to fill orders, right? Think of it as a paintbrush, right? So how do I give me one sec. Right. So paint, how do you paint a wall? You paint the wall like this, right? This is how you paint a wall, for example, right? So why do I keep coming back? Why do I keep coming back? Because I need more paint, right? Imagine if the paint went like this, and then it went like this, then it went like this, right? At some point, let's say I want to keep going up, right? I don't want to go down, right? I go up. At somewhere here, I'm going to run out of paint, because I dip the paint into the box and keep painting, right? So you go, dip, go up, dip, go up, dip. You cannot just keep going forward. That's the reason you see, even when this move happened, it went down, up. I mean, wait, give me one sec. How many times did it go back up? This candle, it went up. This candle, it went up. This candle, and then, dipping back up. So think of a price as a paintbrush. The bottle of paint is money. Without money, price cannot move, right? Price has to hit a certain level of liquidity, which is going to push price forward. For example, right? So I'm going to draw a line here. This is the latest fair value gap, right? It kept going down, and then it just didn't have the energy to go lower from here. No more energy to go lower. Where is it going to go? It's going to go to the internal liquidity. What is internal? Internal is inside the current range. Internal liquidity inside the current range, and external liquidity outside the current range, right? So after this is reaching external liquidity. Why? Because this was the range. Go down, dip back into the bottle of money, bottle of paint or whatnot, and then keep going downward, right? This is just for illustration purposes. I'm going to explain it in a bit detail. This is the 1-minute chart. So ideally it's best understood on the 15-minute chart. So 50-minute chart, and I said price moves from internal range liquidity to external range liquidity, right? Let's take this for example, right? For example, let's start here, right? What is this? Why did price stop here and not anywhere else? Because there was an imbalance here, this gap that was almost completed all the way. That means it went down. This is the bucket of paint, the bucket of money. This is internal liquidity. Any fair value gap, this is internal range liquidity. This is internal range liquidity. This is internal range. Any fair value gap is going to be an internal range liquidity. An external range is ideally going to be highs and lows. So this is external range liquidity, right? So I'm gonna try to explain exactly what happens from each of the circumstances, right? So here we start. Let's start from here, right? This is us tapping into internal range liquidity. And then where are we going to go after internal range? We're going to go to external range. What does external range mean? This, since we came up this way, liquidity is going to be sought the other way, right? Because there's orders here, right? And I'll also explain why you have those long ass wicks, right? So internal range liquidity, and then it moved here, right? So that is one move. And how does it move here, right? I'm gonna skip over power of screw that, right? So consolidate, start moving in the opposite direction of where we came to get the liquidity, right? We came here, got the liquidity, move away from it, right? At some point, you're gonna run out of paint. You're gonna run out of money to keep moving. You run out of volume to keep moving. So what happens? You come back here. So at any point in time, for example, if you don't know what happened after this, right? So you would never know what's happening, right? Because different models call for different setups and different things happen at different times, right? So you would never know if price is going to reverse or not. That's what you use your fib tool for 50%, and you wait for a candle closure above the 50%. If it closes above the 50%, that means it's gonna continue in that direction. But in this case, it never closed above 50%, right? I mean, it did close. There was one closure above 50%, but anytime it closes above 50% and the next candle drops immediately back outside of the gap, it is invalidated. It doesn't matter anymore, because for all logical purposes, it only tapped 50%, right? It's not 100% accurate. Well, I would say it's 90%, 95% accurate. So you move further away from the liquidity, come back and further away. This is what I'm talking about. And you see where exactly we're going to, right? There was external range liquidity for this range. For this range, this was external range. It goes out, comes back in, takes some internal range liquidity, and goes out for external. And anytime you see a pivot, it's going to happen at some of the equal highs and lows. Touch it, touch this, go back up. Touch this, go back up. Touch this, go back up. That didn't happen because this was rollover week right around here, 13 to 15 June. You gotta be a little careful around that time. But like I said, goes down, take liquidity, almost back to this fair value gap, almost touch this. So liquidity is everywhere, right? So internal range liquidity could be a fair value gap, an external or an order block. Order block, I really don't like order blocks. I'm not going to talk much about those because fair value gaps are enough for us to make enough money. So tap here and then go to external range liquidity, right? And so that is that. At any point, right? For example, let's take this is low probability, This is higher probability, right? And there's only two models price moves in, except this bullshit. This is bullshit, right? Except this bullshit, there's two only two ways the price can move, which is a buy model, which is MMBM if you're trying to look up any information about this, and sell model, MXM, right? XM, SM, whatever. Buy model, how does it work? There's some liquidity here. Price comes back, create a fair value gap, tap, go back, tap, go back, right? It's not as clear, but I'll show you exactly what you need to look for in that case, right? So this is a buy model. So liquidity, you take out liquidity, you reverse, and there's always going to be an inversion fair value gap here, exactly at the V point, the V-shaped reversal that the retailers call it, and then it's going to go out of a range, displace, come back to the 50%, or it can take all the liquidity, it can go all the way. So this fair value gap, for example, the first or the second fair value gap after the reversal is something that is going to be filled up most of the time, not just 50%, not this way, but this way, 50%, not 50%, 100%. So this is a buy model, and you also know what a sell model is, right? Price comes up, takes liquidity, V-shaped. Stop with all the gay Elliott wave shit, because they don't exist. It's a myth. Yeah. Fair value gap, and fair value gap. It's not as simple as this, but let me just try to draw this again, just to show you what are the variations that can actually happen when. Jesus. Yeah. So take the liquidity, come back here, go back here, and now it's gonna come back here, maybe go back here. But essentially what's gonna happen is displacement. What is displacement? This is a displacement. This is a displacement. This is a displacement, right? It's going to come to the liquidity and it's going to displace. Oh God, what's happening? Anyway, just rewind and take a look at the gaps again, and I'm going to zoom out. Look at this. Is this not a sell model? This move was a little out of the ordinary, but take out liquidity. Take out liquidity, displace below, come back, tap it, displace below, right? Ideally, they should have tapped this and then kept going below. But at some point, they're gonna manipulate it, right? Someone's running the algo. I don't know who it is, but they're gonna run it. They're gonna keep running it. So the sell model in a sell model, right? Displace below, liquidity, internal range liquidity, the gap you see here. Displace below. Leave this tiny fair value gap open. Bigger fair value gap, go out, tap back in. Go back, down, tap back in. And I'm sure you can see how many times this happened, right? Went down, touch, go back. Touch, go down, tap the fair value gap, go down. Create another fair value gap, displace below. After displacement, come back, keep going below, right? So price is always moving from internal range liquidity, so external range liquidity. So fair value gaps, that is how price runs happen. And yeah, and so I've been looking at 15-minute chart and the 5-minute chart. Let's take a look at the, actually I'm going to look at the daily chart, right? And this is, I'm going to go to the continuous contract so you guys are not fucking sad about this, right? Okay, so I've deleted all the drawings. The daily chart is not as clean as it should have been, neither is the weekly chart, but the 2-day chart is a little bit neater, right? Fair value. So 2-day, 1-day. So you see this here, that's an inversion fair value gap. I'm not going to point out the exact fair value gaps, but I'm going to show you how it happened, right? There's a gap here. Not sure exactly where it is, but this was the inversion fair value gap. Inversion fair value gaps mean this was a displacement lower and the displacement above that gap, right? There was one here, and then you can see one clearly here, and then there's one here, and then one here, so on and so forth, right? After it's created, it's going to take 3 days to make a gap, right? 23rd April, 24th, 25th, right? 3 days. At some point, it's going to come back, take all that money, liquidity, and keep going higher. There's probably also a fair value gap here, which was tapped, and then continue ahead. This one, this is the one that hasn't been tapped yet, but it doesn't have to tap all of them, right? This one is tapped. They have not taken this out. Yeah, so you can see how it displaces, comes back, displaces, comes back, right? So that's enough for right now. What was the motive? Let me, yeah, so SMC, smart money concepts, IRL to ERL, price moves from internal range liquidity, for example, internal range liquidity, this, to external range liquidity, right? To external range liquidity, and then blah 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 blah, all that bullshit's gonna happen. It's gonna take out external liquidity, orders that are above the all-time high. You know, this is the all-time high, 22,411. Move is pre-decided, high time frame movement. It's not going to disobey the high time frame, right? So what happened today, right? We fell short of just touching this again. You don't have to just touch it once and go back, but you have to close above it for the bullish gap to maintain. For example, this went all the way down but closed back up, went all the way down but closed within, right? If it closed under the 50%, it would still be a valid open gap, but unless it closes below the gap, it's not mitigated. So that's it for today. I think it's going to go down here though. I think it's going to go down to this gap. This gap, right? So imbalance and inefficiency drive movement. I'm going to talk a little bit more about inefficiency. Actually, let me talk right now. So inefficiency, fair value gaps are also inefficiencies, right? This is the 1-minute chart. This is an inefficiency, this inefficiency, 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 inefficiency. So that's the exact reason why it wants to tap back, right? I'm going to show you some examples of some more examples of inefficiency. So for example, this is an inefficiency. Just the gap here, this gap. Nothing happens by mistake, everything is by design, right? This is an inefficiency. This was an inefficiency that was mitigated right about like what, 8:43 a.m. and then 9:30 a.m. So 45 minutes mitigated that. This is not an inefficiency anymore. This is an inefficiency. There is no top wick here. This is an inefficiency that was fulfilled. this is an inefficiency. So off market hours, when there's volumes low, there's a lot more inefficiencies, right? So this is one. There's so many here. You can see this one right here, right here, right here. So inefficiencies, for example, what would happen is, if on a day I'm unable to determine a motive, right? So I'm gonna take a look at the action from all the from the Asian session, the London session, right? There's going to be an inefficiency here. This just for example, this is efficient, but let me just take this one, right? Ineffi inefficiency. That's wrong. Inefficiency, right? And there are no inefficiencies here, but for example, just for example, if this was not mitigated, this would also be an inefficiency, right? So if you can't figure out what's going to happen, just target any inefficiency, right? For example, if you want to target this one, what you're going to look for is a move in the opposite direction. For example, a move to these lows or these lows or these lows. You have to take out any one of these lows and then look for the move opposite of that, right? Well, not today, because today is a very extremely low probability day. Market's going to close in about 20 minutes. That is what, 1 p.m., which is at least 3 hours short of the regular day, right? So I'm going to show you what's happening right now. Price, it went to internal range liquidity right now. It took out this high, so external range for this and internal range for the higher time frame. So this inefficiency was just mitigated. If you can see, I'm going to zoom in. This inefficiency, this one was just mitigated. You see, this one did not even come close to that line, but this one, it reversed right after taking that. So I don't know, you know. So what is the most probable next destination for price? It's this. If it keeps going there, this is the next probable destination, because this one is mitigated, this one is not mitigated. There has been no taps in this or even this one. As long as this holds though, there's 3 seconds. If this one closes above, then there is no inefficiency, right? So that's enough for now. If you have any questions, you can drop them in the comments, but yeah, it should be clear by now, but it took me a long time to understand this. So like I said, if you have any questions, drop them below, and hopefully I'm going to drop the next one this weekend. Until next time, peace.